Low time frame trading is a very fast way to trade. Think about trading in minutes, not days or weeks. This style is also called scalping or day trading. We look at charts that show price changes every minute or every 5 minutes. This lets us see small market moves very clearly. People who like action and quick results often choose this method. They are not waiting for long-term trends to develop. Instead, they are looking for small opportunities that happen many times during the day. This kind of trading needs your full attention because things can change in the blink of an eye. So, who are these traders? They are people who can make decisions quickly. They enjoy the excitement of the market's constant movement. Maybe they are traders who have a smaller amount of money to start with. They want to use that money many times in one day to build it up. They are comfortable with technology and looking at screens for a few hours. This is not for someone who wants to place a trade and walk away. It is for the active, engaged person who wants to be right in the middle of the market's daily dance, catching small profits along the way. On a 1-minute chart, every bar or candle shows what happened in just 60 seconds. Imagine watching a story unfold minute by minute. That is what low time frame trading feels like. You see the price go up, you see it go down, and you have to decide what to do right now. A 5-minute chart gives you a little more time to think, but it is still very fast. Traders watch these charts for specific patterns or signals. They are looking for the perfect moment to jump in, grab a small gain, and then jump right back out before the market can turn against them. The appeal is the sheer number of opportunities. In a single day, a currency pair like the EUR/USD or a popular stock might present dozens of potential trades on a low time frame. A long-term trader might only find a few good setups in a whole month. For the low time frame trader, the action is non-stop. This constant flow of chances to make a profit is very attractive. It means you are not waiting around. You are actively participating, using your skills to navigate the market's short-term waves and trying to end the day with more money than you started with. To succeed in fast-paced trading, you need simple, clear rules. A good rule for buying is to wait for the price to show strength. For example, you can buy when the price crosses above a key level, like a moving average. This shows that buyers are starting to take control. Another simple rule is to look for 2 or 3 consecutive green candles on your chart. This pattern suggests upward momentum is building. Your rule for selling or exiting the trade should be just as clear. You might decide to sell as soon as you have a small predefined profit, like 10 pips in Forex. For selling or going short, the rules are simply reversed. You might decide to sell when the price breaks below a key support level or a moving average. This could signal that sellers are becoming more powerful and the price is likely to fall further. Another easy signal is seeing a series of red candles, which shows downward momentum. A simple exit rule for a short trade would be to buy back your position after a small specific drop in price. The key is to have these rules defined before you enter a trade. This way, you are not making emotional decisions in the heat of the moment. To help make these quick decisions, traders use tools called indicators. One of the most popular is the moving average. A simple moving average, or SMA, shows the average price over a certain number of periods. When the current price moves above the SMA, it can be a buy signal. When it moves below, it can be a sell signal. Another helpful tool is the Relative Strength Index, or RSI. The RSI measures the speed and change of price movements. It can tell you if a market is overbought, meaning too high, or oversold, meaning too low, giving you clues about when a reversal might happen. Let's look at a simple example using these tools. Imagine you are watching the 5-minute chart. You see the price has been below the 20-period moving average for a while. Suddenly, a strong green candle pushes the price clearly above the moving average. At the same time, you look at your RSI indicator and it is moving up from a low level. This combination could be your buy signal. You enter the trade. Your rule is to exit with a small profit. A few candles later, the price has moved up and you exit the trade, securing your gain. This all happens within just 15 to 20 minutes. Risk management is the most important skill for a low time frame trader. Because you are making many trades, you will have some losses. That is a normal part of trading. The goal is to make sure that no single loss can wipe out your account or your confidence. A simple and powerful rule for this is the 1% rule. This means you should never risk more than 1% of your total trading capital on any single trade. If you have a $5,000 account, your maximum risk per trade would be just $50. This rule protects you from big mistakes. A key part of managing risk is using a stop-loss order. A stop-loss is an automatic instruction you give to your broker to close your trade if the price moves against you by a certain amount. This is your safety net. For example, if you buy at a price of 1.1250, you might place a stop-loss at 1.1240. If the price drops to that level, your trade is closed automatically, and your loss is limited. You must decide where your stop-loss will be before you even enter the trade. This is non-negotiable for low time frame trading, as it protects you from sudden sharp price moves against your position. Another important concept is the risk-to-reward ratio. This simply means comparing how much you are risking to how much you hope to gain. A good practice is to only take trades where your potential reward is at least as big as your potential risk. An even better goal is to look for trades where your potential profit is 2 times your risk. For example, if you risk 10 pips with your stop loss, you should be aiming for a profit of at least 10 or ideally 20 pips. This ensures that even if you only win half of your trades, you can still be profitable over time. Think of your trading capital as your lifeblood. You must protect it at all costs. Without it, you cannot trade. This is why risk management comes first, even before finding good trades. It is better to miss a potential winning trade than to take a trade with too much risk. Low time frame trading can be very exciting, and it is easy to get carried away. Having strict risk management rules in place acts as your anchor. It keeps you grounded and ensures that you can survive to trade another day, even after a string of losses. Beyond rules and indicators, success in low time frame trading depends heavily on your mindset. You must develop good habits. The most important habit is staying calm under pressure. The market will move quickly, and you will feel excitement when you win and frustration when you lose. It is crucial to keep these emotions in check. A calm mind makes better decisions. One way to stay calm is to remember that each trade is just one of many. No single trade defines your success. Stick to your trading plan and your risk rules no matter what. Another key habit is focus. Low time frame trading is not something you can do while distracted. You need to dedicate a block of time where you can fully concentrate on the charts. This means turning off social media, putting your phone away, and creating a quiet trading environment. When you are focused, you will see the signals your strategy provides more clearly. You will be less likely to make impulsive mistakes or miss good opportunities. Treat your trading time as serious work. This discipline will separate you from the traders who are just gambling. Let's consider a simple example of good habits in action. A disciplined trader starts their session by reviewing their rules. They see a setup that matches their plan and enter the trade, placing their stop loss immediately. The trade moves against them and hits the stop loss for a small, managed loss. The trader feels a little disappointed but remains calm. They do not immediately jump into another trade to win back their loss. Instead, they wait patiently for the next high-quality setup that meets their rules. This patient, disciplined approach is the hallmark of a professional. Finally, we must talk about the rewards and the very real risks. The biggest reward of low time frame trading is the potential for quick, frequent profits and the excitement of being deeply involved in the market. It can be very satisfying to successfully navigate the day's price action. However, the risks are just as significant. The fast pace can lead to emotional decisions and over-trading. Transaction costs, like spreads and commissions, can add up quickly with many trades. The biggest danger is that a series of losses, if not managed properly, can deplete a trading account with shocking speed. This style is a double-edged sword that demands respect, discipline, and a solid plan.